Thanks for having me in. I'm Chris Haddon. I'm one of the owners of Hard Money Bankers. How's the bit going today so far, everyone? Learning some hold stuff, some flip stuff? I didn't make it for the buy and hold, but I saw some of the flip things. So we'll talk a little bit about both sides. I'll do a little spiel, and then Tony, our lending director, is going to jump on and do some of the nuts and bolts of everything. And our wonderful community and content manager, Karen's working the camera and doing all that. Yeah, hard money lending. I don't know how we got stuck with such a stupid name. It just sounds like gangster and like sinister and stuff. I mean, other areas of private finance, they get cool names like venture capital and private equity and stuff like that. And it's really not dissimilar, because we just do private capital for investment real estate deals. Pretty straightforward. It could be big stuff, it could be small stuff, whatever. We lend to people who are using it to make money, just like a venture capital person is, just like a private equity person is with bigger companies. It's really nothing more than that. How many people have heard of hard money lending before today? Cool. How many people thought it was more for the homeowner, can't qualify for a bank loan stuff before today? Because that's very common. Okay. How many people have heard of our company, Hard Money Bankers, just out of curiosity? A few, for sure. Cool. Awesome. Yeah, it's a strange little niche to get in. You don't really plan for that, in college or anything like that, being a hard money lender, but it's a good business. My business partner, Jason, and I founded the company in 2007, so we're coming up on 9 years now, very end of 2007, after we had a little run, about 4 or 5 year run in the banking world. Learned finance, learned real estate. We did some investment deals of our own. We bought some rentals, some we still have. We did some flips, and we liked it. We really liked being in that investor side of things, a little bit more than the consumer side of things. But we thought that we were better at the lending than we were at property type stuff. And that's okay. I mean, people have different skill sets. A lot of people walk into property, and Bahar's probably one of them, goes into property that needs rehab and says, oh, you got to do this and that, and it's going to cost this and that. And I don't get anything further, and like, man, this place is a mess. Like, that's about all I have. My business partner, Jason, would be more dialed in than that, but I'm like, man, this place is screwed up. And that's okay. Different niches, different stuff for everyone in real estate. It's one of the reasons why it's such a cool industry to be in. So around the time we got started, how many people were in real estate in 2007 and 8? Yeah, so you guys know what was going on there. The whole world had just crashed. We had just quit our jobs. We had started a company focused on real estate investing. We were like 20 something, and we had to raise all this money to lend out. No track record, no nothing. It was very challenging. But of course, in hindsight, it was a great place to start because things were at the bottom, right? And it's just been a slow tick up ever since. It's been a good run in that regard. And we saw everything that happened around then. So we're just kind of like, keep it steady, keep it moving, don't do anything crazy. Mortgage finance, stay where you need to be, and let's just continue having a good run. And I think that's pretty much where we've been. Certain areas we see a little bubblish, specifically in DC, but for the most part, it's just kind of steady, maybe leveled off a little bit, and it's fine. There's opportunities everywhere. A lot of it has to do with your buy price. A ton of it has to do with your execution on whatever the deal may be. But we think the market's in a pretty decent spot. And I've always said, because we do a lot of education type things, we've always wanted to be more than just a lending company. We saw doing loans as a very, very 101 type of thing, and we wanted to be just more than that. Like, we made software to give out to clients for free. We do the meetup group and everything else, and the whole community stuff that it's turned into. My business partner and I wrote a book. We just want to be very much more than just doing loans. And one of the things I've been saying for a long time is that real estate agents are in an awesome position to be investors too. I really like the agent/investor world for a couple reasons. One, you have a leg up on other investors immediately because you know the nuts and bolts of a real estate transaction. You have access to MLS. You can comp a property for the most part. And that, you're way ahead of the game right there. Like, you throw in some construction and you're good. Take a few bumps with the experience, learn how to handle tenants, stuff like that, but you're just way ahead of the game already. And another thing that we focus on and talk about is the fee side of real estate versus the asset side of real estate. And I'll tell you what I mean by that. The vast majority of people in real estate are earning fees for something. They're a real estate agent. They are flipping a property even. Wholesale, title attorney, appraiser, hard money lender. You're earning a fee. It'll be paid this week, month, year. It'll be taxed at your ordinary income rate, and that's cool. I love fees. Fees are awesome. Fees pay the bills and the taxes and all that. Fees are great. If someone wants to give me a fee, I will take it. That being said, the other side of things, the asset world, owning real estate, especially long-term, is where the real money's made. I don't think there's any, it's not any kind of secret that a lot of the wealthy people in the country own a lot of real estate and for a long time, even generational, all of that. It grows, you're not paying tax, depending on if you do eventually sell or your rental income, you are paying taxes in some way, but just depreciation of an asset, you're not. And real wealth is made that way. So focus on both. Get your fees this year, get that big number on your 1040, but something that's not on a 1040 that you should be tracking elsewhere is that snowball of assets, right? You're not paying taxes on it, but it is important, and focus on both for sure. Tony's going to jump in here in a second and talk about some of the nuts and bolts and just how it works to get a loan from a private lender like us in order to do your deals. And also, I definitely want to invite everyone to get involved if you are interested in our community in some way. Come by the office when we're having an event. Our once a month meetup group that we had last night at Expectation. We'll probably be moving venues here soon because it's been growing very nicely. If you're interested, we're here for you. That's why we want to be more than just a lending company, is to support and have that community of clients and friends and everything else, and all do some business together. So cool. Thanks for listening to me. Tony's about to jump on.
What's the name of your meetup group?
It's called the Real Estate Investing Incubator. Can we send out a link possibly? Yeah, we can shoot out a link. But if you look up on Meetup, Real Estate Investing Incubator, or anything real estate in Columbia, you'll see us.
Even if you
Awesome.
send me give the link for it. I have it on the Meetup, but and I'll shoot it over to.
Cool.
Oh yeah, and also you guys have great video
Oh yeah.
through REI 360. Like you can just go to YouTube channel and all your.
Yeah, we do a lot of content and that stuff. Jason and I do a weekly web show. A lot of that can be found on youtube.com/hardmoneybankers. Yeah, we do a lot of free stuff. So feel free to check that out. Helen, thank you for pointing that out. I appreciate that. Forgot to plug that. Thank you. Tony? Sweet. Mm-hmm. You got a clicker?
I am. Get this thing set up here. Welcome. He got into a little bit of it. But now I'm pulling a bar.
I can sit here and click for you if you need.
No, it's. I think I had it backwards. Hold on. Perfect. Now let's see. There we go. Chris went over some of this stuff already. So what is a hard money loan? Just kind of back to basics. It's a short-term loan based largely on the value of the property, where the exit's either going to be resell or refi. So where we're going to come into play if you're acquiring rentals is to acquire the property in that period of time where a bank won't refinance you out because there's not any type of ownership or rental seasoning. Obviously, if you're doing a flip, your exit is resale. All of our loans are non-owner occupied. Use of funds has to be for investment purposes, so it can't be cash out refi of a rental so that you can go on vacation. We always ensure that there's going to be a solid exit strategy. A deal is not a deal if you can't get out of it. And so while the numbers might look good on paper, if you don't have the credit to refi or the exit numbers not viable, we're not interested in doing a loan for the sake of doing a loan. So we'll caution you against that. And since it's private capital, it's not appraisal based. I do get asked that a lot from agents who, when they're pulling comps, the way that we comp is different from the way that you're going to comp for a retail seller, because you're looking at that saying, what's the most that I can get this buyer approved for based on the properties? Well, we're hedging the opposite direction of what's the least that this property might sell for. And that's the number that we want to hedge on. And if you make more money, that's awesome. Chris went over a lot of this, but basically I'm just going to go over who we are, what we do, how we do it, and the overall investment options that are available to you in terms of doing deals. So to tip off to the first one, just a few pics from the office, the team. If you go to the meetup, we try to get as much of our team out there as well. We're located in Columbia, right off of Shaker Drive in 32. Founded in 2007. We have offices in Columbia, and we also do deals in the Philly, greater South Jersey area with a loan volume of about $35 million a year. of about 200 loans. So all we're doing is constantly vetting, and gentlemen that asked about contractors, come to the meetup, rub elbows, you're gonna have lots of connections real fast. So in terms of what we do, 65% of after repair value is the key formula that we use, and we suggest that your max purchase price or your client's max purchase price is going to be 65% of after repair value minus construction. If the numbers work, they work. If they don't, they don't. If you try to get too emotional with it in terms of, but it's a great house and it's a great area, go back to the formula. Again, it can be that 65%, let's say it's a $200,000 exit, we would loan up to 130. So if your purchase was 100 and your rehab was 30, you just come to the table with closing costs. But if you're only able to get it for 110 and not 100, it would be closing costs plus that gap of $10,000. Closing is as quick as 5 days, soup to nuts. Generally, it's 72 hours after receipt of clear title. So that's never really a concern, and that's really advantageous to you and your clients when you're making that cash offer, because it really is synonymous with cash. I've never heard of a buyer putting in a contract as cash and not getting an addendum signed to substitute hard money. And again, we lend in Maryland, DC, Northern Virginia, and the Philly, South Jersey area. Yes?
Sorry. So the way that you've seen the offers written, they put it in with no financing contingency, and then they had an addendum that says subject to hard money,
or for example, like auctions, they don't give you the option of financing, it's cash only.
Right.
So all the auction properties that we fund, as soon as they win it, they just send an addendum that says I'm substituting, so long as it doesn't change any other aspects of the contract. But from the larger companies that are trying to move distressed properties, the term hard money is synonymous with cash. So because they know we're not approving the buyer, we're approving the property.
Because I've had REO agents tell me that they wanted to see other hard money, like actually written on the contract, and not straight no financial contingency.
That's fine.
Okay, yeah. I just wanted to.
Yeah, but I mean, whatever is the individual preference. All I meant is it's not.
It's like cash, but it's not.
Correct.
I will add, if you don't mind, on this that, I've needed on one of the properties to get a letter.
A proof of funds.
That a proof of funds. So they will send you that, this person has these funds, here they are, this is the amount, as proof of funds, they are available as cash.
Yeah, we've approved John Doe for $130,000 on this specific property.
Yep. So it's almost as good as cash for it. I mean, I've never really run into problems or seen people that do, but.
So the bulk of what we do, the loans are for fix and flips. That's really where the leverage of the full 65% of ARV is. We do bridge loans, rental acquisitions as well, but to extract the most value from us as a company, that's going to be the area that we can help the most on. But as like I said, we do rental acquisitions, short-term cash out refinance. So when I'm talking to borrowers, I'm asking a lot of questions to get an idea of what they're working with, because let's say you're going in, you have 3 rentals that are free and clear, and you want to go into this flip, but you don't have the 50 grand to put in it. Well, we can cross one of the rentals along with the new subject property, extracting the value for zero cash to close. And some people say, why would I want to tie up my rental and not just use cash? Well, what if 2 weeks from now another deal falls in your lap and you're out of cash? Opportunity cost by not doing that next deal is too great to risk. And that's, like I said, cross collateral. We can also do commercial loans. So if you're dealing with clients, office condos, suites, restaurants. Now kind of where the magic happens, it's all very, very simple, easy process. Everyone's used to dealing with retail buyers and Quicken Loans and all these other major banks. And is that an easy process? So we underwrite internally. Like I said, we don't go buy appraisals. We've been doing transactions since 2007 just in this area alone. So we have a very good idea of what we're comfortable with in the area. And we're going to base our number in terms of what we're comfortable to lend primarily on what's perfectly renovated house in this neighborhood would go for what? And then we take into account experience, because if it's a first-time flipper, it's not going to be perfectly renovated. There's going to be stuff that's going to be missed, and I've said it, I've heard other people say it, but I've got the best contractor in the world. Yes, but if it's your first if it's your first flip, it's not going to go perfect. And credit. Credit is not a huge part of the equation, but it does make a difference as to whether or not we're going full 65%. So, in terms of how to apply, the only information that I need is basically what's going to be right here. Obviously the property address, what the purchase price is, what the rehab's going to cost you, what you think the after repair value is going to be. Again, that ties into the experience side of things. What's the credit score? And the experience, if it's one of your clients and not yourself, so we want to know how many flips they've done. Do they have any construction experience? Have they been studying the market long? No, they just won the lottery, and they used to run a custom barbecue catering business. Okay, well, we're going to take that different from an agent whose dad was a GC, and now he's getting into flipping.
So do you work with new flippers?
But again, it would be one of those things, and they say, well, Tony, you guys advertise up to 65%, and it's correct, it's up to 65%. But if a perfectly renovated house in the neighborhood that you're in is going to go for $200,000, and it's your first transaction, we're probably going to lessen that number to probably say like 175, maybe less, just depending on, because it's contingency for the mistakes that are going to be made, because it's just inevitable. It's a learning process. After I get the information, quote, paint you a picture of cash to close, much like a good faith estimate. That'll come in the form of estimated use of funds. You decide you want to move forward. We then collect a fee for the BPO to be conducted. It doesn't affect the loan amount. But when we've sent you the quote, and it usually happens within 24 hours, we're committed to that amount, provided we don't show up at the house and it's been completely misrepresented, or the back's missing, or it's been swallowed by a sinkhole or something crazy like that. We're good to go. And that usually takes anywhere from a few days to a week to get back if we're doing a commercial valuation. And then, like I said, we're ready to close 3 to 5 days. So you can have Monday, the deal gets accepted, we quoted it the previous Friday, we can close that next Friday. 3-month minimum, 12-month max. In terms of documents, again, very, very simple. Take everything you know about that retail buyer world out. We're not looking at income. We're not looking at any of the debt to income ratio. All we're going to need is the contract, scope of work, any relevant business entity documents, photo of a driver's license, and a bank statement for cash to close. It's that complicated.
Aren't banks easier? Come on, come on.
Sure. And just one thing to reiterate too, I know Bahar said he's done some work with another lender as well. Unlike the federally backed large institutions, all hard money lenders do things their own way. So, I do get a lot of, well, so-and-so does it this way. Like, that's awesome. Taco Bell sells tacos. McDonald's sells hamburgers. They're different. We're not part of that owner-occupied regulated sphere that everybody has to fit in this tight little box. So in terms of overall investment options, obviously your first opportunity is cash. If you can do your deals in all cash all the time, that's awesome. You can get bank financing. It's a little more difficult. Private investors, and obviously hard money lenders. Or you can structure a deal as a JV partner. I'll get into a little bit more about that. So cash, obviously it's the least expensive because it's your own money, you're not paying yourself any interest, but it's also the hardest to come by, and it's going to limit your ability to grow. Because if you have all your cash in one deal and another deal falls in your lap, you could have made 100 grand that quarter, now you're only going to make 40 on the one flip, as opposed to, so in terms of leveraging your profitability over time, this is going to be a very limiting way to do that. In terms of bank financing, who likes dealing with banks? That alone could tell you how difficult it is to get. The primary reason behind that is banks don't know how to underwrite. And so they throw all these other stipulations out there because they don't know the values of the properties to make sure that they're secured in the loan. And there's lots of red tape. You know, we need credit, we need seasoning, we need income, we need, 5 drops of blood, and you got to do this dance and all this other fun stuff.
First one.
Private investors. So, Uncle Gary, somebody like that's got some money to invest, and you've been doing some flips. That's another good option. And the reason I've underlined can be flexible is some private investors are notorious for getting in there once they put up all the money and they show up on site and they want to change your kitchen, or they want to change the flooring, or they're this or that. Or you're halfway through the flip and all of a sudden they call in their note. Oh, I need my money back real quick. I need to buy inventory for another business, or this or that, and you're stuck. So there's a lot less autonomy, and they can be a job in themselves to manage, because they're constantly calling you, how's it going, what's happening, why are you using this color, why are you using that, and which can be very, very annoying. Now you have, from hard money lenders, and I can speak to this from our standpoint primarily, double-digit rates, 4 points up front. We're going to want some cash in the deal, so we're kind of tied at the hip. As I discussed before, if you have $100,000 worth of seed capital, and if you can be doing multiple transactions in the same quarter as opposed to one transaction with all that cash, you're going to exponentially increase your profits. And as local experts, we do add value. We want this investment community doing more deals. Having written 200 plus loans a year, and you're in a neighborhood that we just closed 3 houses on, we can bring up a lot of points that you might not consider. Things like Baltimore County versus Baltimore City, that makes a difference. If you're on this side, that side, how many of you guys are familiar with Loyola? How versatile is that little pocket? And I was talking to an investor out in California that was looking at a property right there. And he was like, well, it could go for this. And I'm like, yes, but it's also right next to properties that are going for next to nothing. So it's one of those things, if they're comfortable and you're comfortable with the risk, go for it. Yes?
Do you just lend in Maryland?
Maryland, DC, Northern Virginia, and the greater kind of Philly, South Jersey metropolitan area. So JVs, they're going to be the least profitable for you, and least profitable for us if it turns out that we do the JV, because you're doing a 50-50 profit split at the end. Sometimes it can be little to no cash, depending on if you're doing a JV with a private investor, they're putting up all the cash, you form an entity, and then they end up splitting it. And choosing a partner can be difficult. It's almost more, one of the most important decisions you can make, because what are the qualifications? Can they execute? What happens if they let you down? Again, these are all the different ways to do it, and each has their pros and cons. As we discussed before, investment community support. We do the monthly meetup groups that have been growing continually. We do lots of content. YouTube, we do podcasts. Jason who's our chief underwriter, has a thing that he does called Private Money Minute. If you want to hear, really, really in-depth knowledge on every aspect of hard money lending, it's crammed. It's usually 1 minute or so, and he takes a different topic and runs through it. And then we do the podcast. We have video guests on. And again, we want to bring as much value to the table as humanly possible, because if you're not doing deals, we're not doing deals, we're not funding them for you. Please, if you have a moment, take a chance, check us out on Facebook. That's another place that, what was your name in the back, sir?
I'm sorry?
What was your name?
Dirk.
Dirk, this is another way that you can find more contacts. Go to our Facebook page, put a post, ask a question. Also Instagram, which we try to put as much value wherever an investor might be. So, The application process is really simple. Like I said, phone call or email, hardmoneybankers.com. One of the first things you're going to see is a big Apply Now button. Just hit that. It takes literally a minute and a half max to type in all the fields. We're not asking for much information at all. You can call us on the 800 number anytime, or email me directly, Tony@hardmoneybankers.com. Any questions? Yes. 14 and 4. So 4 points due at close, 14% annual rate, so you're making monthly interest payments while you're utilizing the capital. 3-month minimum with no prepayment penalty, 12-month max. But if you're at 12 months on a flip, something's usually gone wrong.
Very wrong.
There's a couple other folks had questions? Yes.
So you said you do about 200 loans a year. About how many applications do you get here?
A year?
Yeah. What's
12, 10, probably 10, 12,000.
We fund about 1% of applications.
That's about one.
Yes.
So so you're funding 1%, right? So the 99% is it. What would you say is the prevalent thing that causes you not to fund a deal? Like, is there like something?
It varies, but keep in mind too, a lot, like, just like the phrase, everything you see on the internet's true. A lot of the applications that find their way through our online application process, I would say of that we do 1%, but if you take into account applications from repeat borrowers and or people who we see at the meetup group or active engaged investors, I would say it's a higher percentage.
So it's not the ones that are coming in at 3 o'clock in the morning that we saw a video.
Sometimes. You'd be surprised, but there's also a lot in there that it's close, but the way that we're structuring it, you're gonna need 35 grand in the deal and you only have 25 and you can't find a cash partner, so you get out of it. That happens too. Yes?
What's the minimum amount that you can get a loan for?
We don't really have a loan minimum, but we find that our stuff works best in kind of that median income level home buyer arena. So I would be pushing for ARVs of 150 to say like 750, because you get above, or I would say even like 450-ish, because you don't want to get out of that non-conforming loan for a retail buyer to purchase it, because then you're limiting your buyer pool. A flip should be like any other business quote-unquote widget: buy low, sell high, get in and get out, and turn your profit. Any other questions? Yes.
What is the credit score factor?
It depends on the person. I mean, are we talking a 600 credit score but a 10 flip history of excellent product? Or are we talking...
Brand new.
Again, what's the property? How much rehab does it need? Are we talking a full gut renovation and no construction experience? Are we talking kind of paint, maybe a new kitchen? Yeah, just something cosmetic.
Okay.
So it's
Variable based on the...
It's common sense lending.
Okay.
It's, if let's say a family member were to come to you to fund a flip, what kind of questions would you be asking? It's our cash. We're going to structure it in a way that we think that we're covered, and the credit score is going to be a piece of that picture. But again, there's no, deduct this for that, and there's no matrix of some magic number that gets spit out. We discuss it and we talk about it. Could go this way, it could go that way. Baher knows we've had multiple discussions about it, about what a value and a loan amount might be. One second. Go ahead.
So what's the best way to start as a new investor? What would be the safe haven to start?
Learning what the number is and what the deal is, and like getting the deal. And I would say that's, if you have a solid property under contract, wholesaling is going to be the safest way, the least risk way of getting there until you get your cash, up to speed. And then after that, what's a good first deal is maybe something that doesn't need much work, that, through the course of wholesaling a few properties, cherry pick the best one and make that your first flip.
Okay, thank you.
And what was the credit question?
Well, I just want to know, so if you have someone that brings like a great property, they have all, the presentation is outstanding, but their credit score is a little wavy. Maybe, you know, I have a client that has a credit score that's below the 6, but their presentation, everything, you love it. So, I mean, would you still?
Yeah, we would just loan accordingly. So instead of the let's say it's a 200 exit, and we know they can execute on it, but the credit's a little shaky, maybe we're at 110. Or maybe we're at 120 instead of 130. Again, everything is very, very deal specific.
Okay.
It's the property.
It's the property.
Any other questions? Yes.
You said it's 14% interest, 4% or 4 upfront points. Can you roll those points into the loan?
No, but we can front and back end them if we need to. And the reason why we don't necessarily roll them in is because, again, you got to have some cash in the deal. And, you know, that being said, over time you build relationships, and we learn how to structure it to make it work for a win-win. You know, just like most of your retail clients you'll deal with once, twice if you're lucky. We're looking for that long-term relationship. So it's, you know, a question of why do you want to roll them in versus not up front? Well, if you don't have enough cash in the deal, then that's already kind of a red flag on your exit, because are you going to have enough to make the interest payments? Are you going to have enough to do the construction fully? Yes, ma'am.
You said bank statement. How much you want that person to have in the bank in that bank statement?
Just as much as I think they're going to need for cash to close. So based on that estimated use of funds form, it's going to say, I estimate your cash to close to be $27,000. We want a bank statement that's got at least that much in it, because otherwise we're just spinning wheels. It's, you know, the title company's going to want it for the same reason. Anybody else? Cool, thank you so much.
Thanks,